Hi guys, John here, Forex Fire. So I hope you are all enjoying the group and what we have built over this last year and a bit. It's phenomenal, and now have over 230 odd people within this community. I started this off with just around about 5 or 6 people with the intention of just to trade alongside them, but now it's massively grown as well. So thank you to everybody that is sort of partaking and engaging in the community. So, little bit about what I've been doing and what I'm going to start bringing into the group as well. Supply and demand. I've been trading for 4 years, the last year and a bit, heavily with the bankers. Okay, my very first time of starting out, it was a struggle, like it is for everybody, to be fair. But as the years got on, and especially going in my 3rd year, I sort of had that massive light bulb moment where the fog just sort of lifted and I could see everything on the charts, to be fair. And now I'm thankfully, because I've stuck the course, I'm sort of able to take my hand to more or less quite anything on the charts, to be fair. I can look at a concept, I'll look at a strategy and have the ability to either break it down and sort of help others understand it, or 2, look for little nuances within the strategy and make it work around my market conditions. Okay, and this is certainly the fact with supply and demand, because I do know that bankers and things like that, it can be daunting when you're first looking at it, but it is most certainly the most rewarding. Okay, when you have the right risk management built in. Now, I've got to stress this as well, because it's not often talked about within the group. Whenever you do any sort of trading, you need to protect your capital, get the teeth in. You need to be able to risk the proper required amounts. I will generally only risk 1%. I've even been known to go down and risk 0.5% per trade. Once I'm getting a good gain, I tend to take my foot off the pedal. I'll only have a look for maybe 1 or 2 trades per day. Some days I don't even trade. It all depends on, 1, how I'm feeling for that day, and 2, it's basically down to if I feel the charts are starting to show their hands. And lastly, yeah, I may have gotten a good trade, so then I just think, well, I don't need to trade anymore this week. So again, you just gotta. Back in the day when I first started, it was all about getting pips. That's all I was taught. Now you suddenly realize it's got nothing to do with the size of the pips that you get. It's how you protect your capital, it's how you use your capital, and it's how you risk your capital that gives you your exponential growth on the actual account. And risking just 1% to get, like I said, this week, I think I got about 8 or 9%. Don't need to trade no more, not this week anyway. So again, I'm going off on a tangent with that. So this is bringing me into the stuff with supply and demand. Been trading this for a little bit of time as well, and I can see how this can tie in very nicely with the bankers stuff for the people that are finding it a little bit difficult on the bankers, but it possibly give you what I would like to call a set of stabilizers on your vehicle that you're using, which is Forex, giving you those stabilizers on Forex to be able to identify the important POIs, which is the point of interests, which are the bankers areas, okay, without having to draw swing point fibs. Okay, so again, that's going to be the preference of this with what we call, and there goes my teeth again, with what we call supply and demand. And I'm going to drip feed these into a new module into the group that we have. Okay, so I'm just going to share my screen. This is just a quick brief video just to see what I'm going to be intending to do. Just shared my screen. Now, supply and demand, without going into too much detail, okay, if you can imagine support and resistance, best way for me to give you this analogy. Normally in trading, retail traders will go for, okay, go for support and resistance. And I'm just going to change the color of that. So you've got, on the top, you've got the green, on the bottom, you've got the red, okay? Now, price price as we know, tell you what, we'll get this. Price as we know comes in, okay, like this. And it starts hitting. You might get some bits of prices like this, but in essence, it's in a consolidation zone, okay? So we're consolidating. Look at this. So this could have, before it came into this, it may have came from the bottom, okay, and then went into the consolidated phase, or it may have been on a slight downtrend, okay. So what we'll do, change that one to green. Past black, one to green. Right, so it may have came up into a sort of from a buy-in situation, then went into consolidation. Again, if you're coming up from the bottom to the top, this consolidation could be known as a distribution area, okay. If it comes from the bottom area, if it comes from a downtrend from down and then goes into a phase consolidation on the bottom, it's known as accumulation, okay. Those two terms are those two terminologies of no importance at the moment. What we are explaining today is simply supply and demand, where within this particular zone, where we either go into distribution or accumulation, we have got where the retail buyers are, okay, where you've got the sell stops, the sell limits, the buy stops, the buy limits, okay? And this is where the banks love the pool of money to be sort of put into the areas. And again, you could have these as equal highs, equal lows, liquidity, those terminologies. But for supply and demand, the top end of the consolidated zone and the bottom end of the consolidation zone, okay? The demand, when the price is at one of its lowest within that area, okay? I'll say that again, when the price is at its lowest within the area, this here, and this is just an example using the consolidation zone for that. This would be known as a demand area, okay? A demand area, demand 1 hour I've got. And if you want to know how to do this, it's easy. It's just simply when I'm on here, I go to cog, I give it a coloration on the style, okay, background. I have text, and then I'll put in, if I'm on the 1 hour, I'll have demand 1 hour, top alignment, center alignment, save as, and then I will call this demand 1 hour. So when I'm looking at my charts, that box is clear for what I'm using it for. Now on the higher end, we have the supply, and again, got this mark out already. And I have those two set at two different areas. Now, again, for the accumulation or the distribution, this is just an example for where the ceiling and the floor is, okay? Just so I can highlight it. Okay, so what I want to do, I'm going to try and scroll down. And I'm going to give you an example. Just for today. Just for today. Let's have a look. So, I'll cut off the noise on the bottom. So as you can see, we've come into this area. Now the preference to make the zone, okay, whether it's on the demand or whether it's on the supply, it is the same preference as the bangers, okay? So we are going to use a zone rather than the fibs for the retracement, even though the fibs will give you a money zone, as I call it. This may give you the stabilizers that you need to get your eyes trained on a certain particular area or point of interest, okay? So we've got on here, bang, okay, we're in that uptrend coming out of this area of consolidation, okay? And then we've come down. So this here is an order block. I've spoke about this on one of the other modules that we've done. This is an order block. Now, price will always come back in to respect these areas. Okay, now I've got a lot of lines in here. It's basically a 0, a 0.25, a half, a 7.5, and a 1. Okay, now each of those areas are also known as quarters within our zoned 1 hour candle. Okay, so as price comes out, because this is where the contracts are within this candle, price has to be mitigated within this zone. Okay, and again, I'm just going to quickly show you an example. It's a bit like your imbalance. Okay, the best way to do it is your imbalance. What you've got from your imbalance zone. So you've got there, just to go off on a tangent, and you've got there. So this here was in balance, right? This here was in balance until price has come back in to fill in its inefficiency, right? So this is going to be working on the same preference as an imbalanced area, right? Hopefully that bang, that's giving you a little bit of a light bulb moment. I'll repeat that again because I like to go over these as easy, as slowly as possible, just so it sort of gets into your head. In balance, and again, let's just see if I can get this. We've got an imbalance area here. Okay. This here, when this candle went up, it's left inefficiency. Okay. So the contracts on this inefficiency, this imbalance, have to be met. Look. Bang. Now, again, just to give you that aha moment as well, watch this. I need to get rid of the prices. Get rid of the levels. Now these quarter points, look, touch, 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 touch. You can't make this up, guys, okay? Again, hopefully, bang, this is like giving you wow, wow. You know, so again, I mean, I've gone off on a tangent a bit. Imbalance areas, and again, these areas on the zones, these quarter point areas, okay, are very, very, very important. Very important. From there, you can see we're concentrating on this zone, okay? So again, we just get rid of levels, prices, bang. So this here, just to zoom in, this is where we are concentrating on. From there, we've got a zone for this candle. It works on the same preference as an imbalanced area. And again, on the preference of that, we are waiting for price to come in and mitigate into technically like an imbalanced area. Okay, so it is an order block, as it's called. And we are waiting for price to come back in to fill the contracts of this order block. Or in this instance, this here is called a supply area. Okay, so on the top is your supply. On the floor, you've got demand, okay? So you've got the floor, you've got the ceiling, you've got support, you've got resistance, okay? Now, the reason I've got the demand as this area, you can see here, it's the last sell before the buy. It's giving us a zone. Again, normally I'll go with 50%, okay? But in this instance, in fact, we'll make that 50%. Normally 50% is a good area to go for, to be fair. So this is zoned off to here. This has given me a risk to reward of 1 to 11.6. However, structurally, I'm looking to the left of this here. Okay, I can see a significant line of interest. Again, another structure point. See this here? Just to show you guys. You've got the last down. You've got the last down before the up. Look, price hasn't come down to hit this at the moment or come back up to hit this. It's come down and it's filled the contract of this, okay? And again, there may be some more within this wick if you go down a time frame. Let's go down to 15 minutes. You've got imbalance there, clearly imbalance. You see the imbalance between that wick and the wick up here? There's a lot of imbalance between there, and it's filled the imbalance of that area going down to the 15 minutes. So again, we're going off on a tangent. I just want to go back to here. The reason I have this here set as an area of importance, it's so if we do get the mark up and we get in on the trade, okay, we come down. Once the price hits this level, this point of interest, I will be looking to close out 50% of my trade, okay, and move my stop loss to break even plus a couple of pips and then let it ride, okay? So what you're looking at is to here, risk to reward 1 to 4.6, okay? So you possibly got what, just over a 2% gain. If that's because obviously you're risking 1%, you're taking it down to the, you're taking out a half, so you're probably getting a 1% on your price there. From there, guys, you then move your stop loss to break even plus a couple of pips, but your trade is still good. Your trade is still good until it gets down to here as well. If the trade goes the other way and it bounces from this point of interest back to your stop loss, all's not lost. You've closed out in profit, okay? So again, those sort of things I'm going to be teaching as well. I'm hoping this video, or this first part of the video, the introduction to supply and demand, has sort of opened your eyes a bit on the understanding of the order block, okay? And obviously the coloration on how to color it and give it a letter or a number, okay? So what I'm going to do the end of this week, I think we'll do some homework on supply and demand where I'll get you to draw. We'll draw those out, but I'll put that into the group on the weekend, possibly the end of Saturday. I might do that Saturday, or I might do it later on tonight if I get a little bit of time, okay? So that's the introduction to supply and demand and the basic premises of it, okay? So I'll just stop the share. I'm going to put this as a new category inside of the group, okay? And if it's something that you want to learn, give us the thumbs up. If we get plenty of thumbs up on this video, then I'll possibly be going into it a little bit more and drawing up some more videos for you guys, okay? So I'm sorry if it went on a tangent a bit, but I think I've thrown in a couple of little golden nuggets on there with regards to not just the supply and demand and what it's about, but also the zones, and giving you a nice explanation on how the preference, on how it works in conjunction on the same long lines along as imbalance. So again, you've learned about imbalance in this group here, okay? You're not going into something that is totally different. Just think as the supply and demand a bit similar to what the imbalance is, okay? You've already learned imbalance. We're just giving you a bit more of a push on the bike with regards to taking the stabilizers off and understanding the price action a little bit more when it comes to trading. Okay, guys, so give us a thumbs up and let us know what you think. See you later.